Okay, welcome back to integration of financial statement analysis. Now we're going to turn our attention to earnings quality and cash flow analysis. Let me just remind you of your learning outcome statements here that we've been covering all of our modules. We had to identify financial reporting and choices and biases that affect the comparability and quality of financial statements, evaluate and recommend adjustments to improve quality and comparability, and to analyze how balance sheet, earnings normalization, and cash flow modification affect our financial statements and ratios. Okay, so it's earnings quality and cash flow analysis now. Now, when we talk about earnings quality, before we've talked about it being ROE greater than R, in other words, generating returns greater than our required returns. Now, of course, not only does the return on equity need to be greater than the cost of equity, but we need sustainable earnings. Now, if you remember, sustainable earnings are considered high quality. Volatile earnings components are therefore lower quality. Now, in earlier readings, we talked about earnings backed by cash as being stable, okay, and therefore persistent and high quality. Earnings coming purely from the accruals process, though, by definition, are going to be much less persistent, much less sustainable, because accruals automatically reverse. So what we're going to attempt to do now is take the company's earnings from the income statement and split them between cash-backed earnings, high quality, and accruals-based earnings, low quality. Now, we've got two different approaches to do this. We can either use the balance sheet approach or the cash flow statement approach. And we might see some differences between the two methods, normally due to classification issues in the cash flow statement. Okay, so what we're going to try and do is measure our earnings quality by looking at the ratio of accruals to average net operating assets. Aggregate accruals over average net operating assets. Now, we haven't defined net operating assets yet, but we will do in just a second. Now, the basic idea is if the ratio of aggregate accruals to net operating assets is rising, that's an interpretation, therefore, of lower quality, whereas if the aggregate accruals to average net operating assets is falling, then it's telling us our earnings quality is improving. So lower ratio, higher quality, higher ratio, lower quality. Okay, so how are we going to, or what are aggregate accruals? Remember, we've really said these are the earnings in the income statement that are generated purely from the accruals process and not actually backed by cash. And remember, we said anything generated from the accruals process will reverse at some point in the future and therefore aren't sustainable. Okay, so in other words, we could take our accruals-based earnings from the income statement, so that's just our net income from the income statement, deduct our cash-backed earnings, and what we've got left, therefore, is the accruals-based earnings, known as aggregate accruals. Okay, so these are the earnings in the income statement that are not backed by cash, purely generated from the accruals process. Now, as we said, two approaches, balance sheet and cash flow statement approach. If you use very consistent assumptions between the two, you can get identical results, but due to different classifications in cash flow statements, we might find a difference between our two approaches. Okay, yes, we've said this already, an inverse relationship in aggregate accruals and earnings quality. The higher the aggregate accruals, it means more of our earnings are backed by accruals rather than being backed by cash. Okay, so let's take our balance sheet approach for calculating aggregate accruals first. Now, what we need to compute is net operating assets. Now, our net operating assets are the company's total assets minus cash. Notice our cash isn't strictly just cash, it's also cash equivalents and marketable securities. Remember, cash equivalents tend to be money market instruments with less than 90 days to maturity. Marketable securities are really going to be our portfolios of trading securities here. So total assets less cash and marketable securities minus total liabilities excluding any debt instruments. Now notice it's minus total debt here, and that is therefore all interest-bearing liabilities, whether they're sitting in long-term debt or whether they're sitting in current liabilities. Okay, so watch out for debt instruments within your current liabilities. Note